10 years from now, there is a version of you who will have paid over $20,000 into a financial product, and you will never see a single cent of it back. It won't be because of bad luck or an unexpected emergency. It will happen because of a single decision made in a 15-minute conversation with a very friendly salesperson. You won't walk out of that office feeling scammed or pressured. In fact, you'll walk to your car feeling a profound sense of pride. You'll feel like a responsible adult who finally took the necessary steps to protect your family. And that feeling of comfort is exactly the problem. In personal finance, the moment a purchase is driven by emotional reassurance, rather than a calculated look at the mathematics, you are usually losing money. The most effective wealth training mechanisms sitting in millions of monthly budgets right now do not look like scams. They disguise themselves as comprehensive, responsible financial planning. The pitch you hear will sound entirely sensible. You know you need to protect yourself from disaster. But why buy a policy that only provides protection when you can buy a policy that also builds your wealth at the exact same time? This sounds incredibly efficient, but the trap begins here by blending two completely different financial tools into a single unified product. Once combined, the product becomes a black box. Think about it like looking at a restaurant receipt, where the appetizer, the main course, and the dessert are all hidden inside one single number. You know the total cost, but you have no idea what you actually paid for each individual piece. The primary function of a bundled financial product is to eliminate your ability to see clearly what you are paying for. To understand what is actually happening to your money, we need to rip this bundled product apart and examine its underlying mechanics. The first component is pure insurance. At its core, insurance is incredibly simple. It is a communal pool of money. A large group of people contribute a small amount, and that pool exists strictly to absorb the impact and limit downside risk if disaster strikes. The second component is pure investing. This is a completely different tool with a different job. Investing is the act of buying productive assets, like a piece of a business or real estate, with the sole goal of building upside growth. These functions are entirely opposed to one another. One is a defensive tool meant to cap your losses. The other is an offensive tool meant to maximize your gains. These are two diametrically opposed jobs. In reality, they were never meant to be executed by the exact same mechanism. Forcing opposing financial forces into a single vehicle guarantees that neither job will be done efficiently. Let's look at what happens to your monthly payment when these two engines are wrapped together. When we expose the anatomy of the bundle, we see that a portion of your money goes to pure protection, and a very small portion goes to growth. But a massive third layer is quietly created right in the middle. This bloated middle layer consists of the heavy weight of hidden fees, massive salesperson commissions, and complex administrative costs. The mathematical reality is that in the early years of a bundled policy, almost none of your money is actually going toward building wealth. It is being eaten by the structure itself. You aren't paying for a premium all-in-one product. In reality, you are paying premium fees to fund a highly compromised middleman. If the underlying math is this destructive to wealth building, why do millions of highly responsible people keep buying them? Salespeople rely on an emotional heuristic. They pitch these products using vivid, highly emotional stories of families left financially devastated, pairing those fears with the comforting promise of peace of mind. When our brains process deep emotions like fear and love, they create a cognitive shortcut. This shortcut completely bypasses our analytical, math-checking filters. We stop asking about return rates and start asking if our family is safe. This trap is aided by complexity bias. Owning a complicated, all-in-one product makes the buyer feel sophisticated and financially put together. This feeling easily masks the reality that complexity is exactly where financial value leaks out. The modern financial industry often relies on your deepest emotional instincts, acting as a smokescreen to hide terrible mathematical realities. The actionable solution here is straightforward. Mentally and physically separate your financial tools into their individual jobs. Instead of buying the bundle, you purchase pure, low-cost protection, like term life insurance, which covers the downside. Then you take the difference in cost and directly invest it into straightforward growth assets. This dual bar chart compares the long-term mathematical outcomes over a 10-year timeline. On the left, the bundled approach shows slow, constrained growth due to the heavy fees. On the right, the separated approach results in drastically larger exponential compounding growth. The separated approach yields vastly more wealth over the decades for one simple reason. Fewer intermediaries are taking a cut before your money has the chance to compound. In finance, doing two things simply and separately will consistently and mathematically crush doing them together in a complex bundle. If you already own one of these bundled products, you might be feeling a deep psychological resistance to canceling it right now. This is a psychological principle known as loss aversion. The human brain feels the pain of walking away from money already spent far more intensely than it feels the logic of gaining better returns in the future. We need to reframe this exit strategy. Walking away from an underperforming product is not an admission of failure. It is a vital, forward-looking mathematical correction. True net worth is generated through boring, transparent, low-cost decisions repeated consistently over time. It is not built on clever stories wrapped in hidden fees. The moment a financial decision leans on making you feel warm and safe instead of showing you the raw, unbundled math, that is your cue to walk away.